We've got a fabulous panel tonight. I've just interviewed them all and that's been fantastic. And Mark's a fabulous moderator, so I'm sure this is going to be really an interesting panel. It's always helpful to know what it's like to be in the investor seat because they get a really good overview of the whole ecosystem. First of all, I'd like to thank Bill Wyatt. Do you want to come and say a few words?
Just welcome everyone. This looks like a very interesting panel tonight. And, FinTech is definitely one of the big businesses in this area. It's one that we're happy to be a sponsor of. So enjoy and learn something and ask questions.
Thanks to Bill and Shep and Mullen. Shep and Mullen have been hosting us since the beginning of 2017 and have been a great support in building this ecosystem. So now I'm going to pass it over to Mark, and Mark will help introduce the panel.
Thanks, Pamela. So I'm looking forward to this discussion tonight. It's a timely topic. There's a lot in the news in regards to it, and so let's go ahead and get going with it. Why don't I have each of you begin just by briefly introducing yourselves and the work that you do in this space. Matt, go ahead.
Excellent. I'm Matt Murphy. I'm a partner at Montage Ventures, which is an early stage venture fund based in Menlo Park. We invest primarily in fintech, but also do healthcare and e-commerce and marketplaces. We've been very active in this space for many years. I joke and say I was in fintech before it was called fintech. I was at E-Trade back in 2000, and they were one of the early pioneers in disrupting the brokerage space.
Yeah, thanks, Mark. My name is Michael Stidgemore, partner and co-founder of Broadhaven Ventures. We do C-stage fintech, both here and Latin America mainly. We actually built out of a fintech investment bank called Broadhaven Capital Partners. Been in existence since 2009. Done about $45 billion of transaction volume, and we do early stage fintech to really help our companies and leverage the Broadhaven platform. Connecting with financial institutions, et cetera. I've also been in fintech for my entire career. Started at Goldman on the strategic investments team, and then early sales hire, built a sales team at Mosaic, solar finance business in Oakland, and then iCapital Network, tech-enabled feeder fund platform out of New York.
Hi everyone, my name is Arjun Acosta. I'm a partner at Flourish. Flourish is a venture fund backed by Pierre and Pam Omidyar, the founders of eBay. We used to be part of a broader organization called the Omidyar Network. We built over time a $200 million fintech portfolio, grew our team, and earlier this year spun out into an independent entity called Flourish with a further $300 million commitment from the Omidyars to continue to invest in the space. We take a very narrow but unique view, which is we work on issues of financial wellness in the US, in LATAM, in Southeast Asia, India, and Sub-Saharan Africa. So take a very broad geographic view, but work in fintech with this idea of helping promote financial health and economic opportunity for the mass market.
My name is Ningo Salzspieler. I'm a managing partner and founder at Strive Capital. We focus mostly in the consumer and software as a service space. I'm also a venture partner with Grisham Robotics, which is not necessarily well known for its fintech practice, but we've actually been exploring quite a number of plays around it. My background, I've been in tech for 23 years. I'm a product guy, so I do a lot of work around consumer, which is a little bit odd. A lot of people seem to like enterprise and B2B a lot more these days. I've operated in over 35 markets, across markets as developed as, for example, Korea and here, as emerging as Bangladesh and Mongolia. And so I have a pretty interesting view on the different markets and how they work. And I've also lived in London, Beijing, and here in the Bay Area for the last 8 years.
All right. Well, let's go ahead and get started. Let's kind of set the scene here from an investment standpoint, and talk a little bit about the common wisdom, which is right now that attractive investments for a lot of people are in blockchain, not so much in coin. Now, that's a common wisdom. I'd like to ask the panel, is that true? Is that still kind of the model on what you're seeing out there from an investment standpoint? Whoever wants to take that first, go ahead.
Sure, I'll take it. So I can give you some data from last year. So 2018, we kind of recut our portfolio and looked at kind of our funnel of deals that came through. The most deals we saw were actually in crypto and blockchain. We don't invest in tokens, but companies focus on that. we did the least amount of deals in crypto blockchain. So we did one, which one of our partners actually incubated with his brother, founded Portware and sold that to FactSet. That was it was a crypto market making business. So we have 16 companies in our portfolio. One is in that space, and I think that's kind of symptomatic of what people have thought about it. I think crypto, obviously, tokens were interesting over the last kind of 2017 to 2018. And then obviously I think there's underlying value in blockchain and the infrastructure. I think from our view, it's a tough space to be in right now. I think a lot of people aren't sure where things are going to go. I think probably two things I'd say stand out. One is I think from a capital markets perspective, there's a lot of efficiencies to be gained using the blockchain. So from that perspective, there's companies like Baton Systems, which Schwark, Satchibol, who's the founder of Yodlee, co-founder of Yodlee, Trinity backed. I think that stuff like that's pretty interesting to provide efficiencies for like post-trade processing, clearing and settlement, things like that. And then I think tokenization of traditional assets I think will be pretty interesting as well. So enabling investors to access kind of fractionalized assets, whether it's real estate, private equity, et cetera. And I think kind of the post-trade aspect of that, kind of reducing operational overhead, creating efficiencies there is kind of interesting. So, but I still think it's a tough space, and a lot of people aren't really as active in it right now.
So although we focus, and I focus personally a lot around consumer, strangely enough in blockchain, I focus a lot on the lower layers, infrastructure and platforms in particular. Infrastructure, we really haven't pulled the trigger on anything very, very significant, but we looked quite extensively at it. Anything from hash processing units to all the enablement facilities that we need for this to actually be a reality. But around platforms, for example, we did a notable investment in a company that's still under stealth in the custodian space. So we are big believers that there are going to be enabling pieces that need to be deployed to the market that we should invest in. We don't do coins either, so we've not done token investments directly. So it's really focused on the equity side that we've been doing. I think there's been a lot of noise around the space, a lot of fraud around the space. I think the regulations that we've seen recently are actually a good thing, not a bad thing, because it sort of creates the boundary conditions for action for everyone in the market, including investors. And so I'm bearish on blockchain short term, although I've done investments. I'm very bullish in the long term. I think it's an incredible technology that will have a lot of applications, a little bit to what Michael was saying earlier.
I think we probably have 50 companies in our portfolio in the fintech space, and I think one is in the blockchain space looking at ID. So again, we haven't done a lot. I think there's a ton of potential from our perspective in an underserved small business market across the globe, right? There's probably between $1 trillion and $1.5 trillion underserved gap to lend to these businesses, but they just don't have cash flows, they don't have P&Ls, they don't have any proof that they're running a vibrant business. But if you can somehow create transparency around value chains and supply chains and who they're working with, I think there's potential to start to use that to unlock a lot of credit. More generally, I think the only space we've dabbled in crypto, 4 or 5 years ago, we made a completely contrarian bet that there might be someday a central bank fiat digital currency. And we invested in a company that's building the technology to allow central banks to create a digital dollar or a digital shilling, which, as markets have ebbed and flowed, seems to be getting more focus these days.
Matt, you want to add something?
Yeah, I mean, we see blockchain, as we see fintech, as more of an enabling technology. And we see as time goes on, blockchain and fintech will be components of a lot of different industries, right? As I look at the US market and how it relates to blockchain or even cryptocurrencies, I see more back office, more infrastructure layer on blockchain, and there's a lot of opportunities there, as the panel stated. For cryptocurrencies, the use cases aren't strong enough for US consumers. If you go down to the LATAM countries, right, the use cases are huge, right? They've experienced massive valuations in their currencies overnight, and so getting control back, right, of the hard-earned money you've made makes a lot of sense, right? And so we've seen those areas take off more so.
All right, well, so you mentioned use cases, Matt, and I think it might be helpful as well in setting the stage here to look at what are some of the use cases that you see out there in fintech, whether it's blockchain or crypto, whatever it might be, that you think could really gain traction in the next 12 to 24 months, what sorts of real applications are you seeing out there, either in your investments or companies that you're interested in? So let's talk about that.
Maybe I can get a fast shot at this. At a high level, it's very funny, I think, what's happening right now in fintech, because there seems to be bundling and unbundling at the same time. You have unbundling of services where you have corporate cards emerging, where you have a lot of services that are very point services. I should be getting loyalty rewards, I should be getting a bunch of stuff I'm not. So someone's sorting that out. They get access to my email addresses and they basically scan what I'm getting. And it's like, well, there actually is a price reduction here, you should be getting that. At the same time, you're getting bundling solutions where people are basically coming together and saying, the visibility I have on the financial services I actually am given these days, be it loans, be it savings accounts, be it investment accounts, et cetera, is all very distributed. So I need something that gives me this visibility at the middle of doing that. So it's, I think, really fascinating to me because it's one of those markets where it's not very obvious that this is going through either an unbundling or a bundling sequence. So I think we'll see both for a long time. I'm very, very interested in the bundling side of the fence, where there are things that are aggregating everything that I have and giving me that visibility and giving me the view of actually how much money am I making? Should I save more money or not? Is it just in a checking account and I'm getting nothing out of it? That type of play for me is really, really interesting, and I'm spending quite a lot of time on it.
Yeah, that's an area that we see a lot of opportunity as well. We're actually calling it kind of a vertical bank. That's really surrounding a certain consumer or persona of a user and building products that meet their needs, right? So earlier bet that I did way back in 2012 was a company called SoFi that was helping Henry's, hiring not rich yet, basically post-grad students refinance their student debt. But then the next challenge that came up is they wanted to buy a house, yet they had so much debt, no one would underwrite them. So they launched a mortgage product. They started expanding the services around that target audience. We've done another bet in a practice finance business. So you have a massive shift going on right now of dentists and vets and eye doctors that are retiring, right? So we like a lot of these macro shifts that are coming in where the boomers are retiring, your next generation of practitioner wants to buy that practice. It's $1 million, that's a lot of money. So there's an opportunity to come in and displace Wells Fargo or BofA, the incumbents, with faster underwriting, a better process, and use that as the biggest pain point for that customer, and then build a financial stack around them and their needs.
Yeah, I think for us, we actually kind of have looked at the vertical banking space, kind of taking the infrastructure layer. So I think our view is that pretty much everything is becoming or has the potential to become a fintech. So I think you're seeing a lot of brands have great customer loyalty, but not have the ability to offer financial products. So you're seeing companies pop up, whether it's SynapseFi, Rails Bank, Bond, just raised $10 million to do that, and they're enabling people to launch charged corporate cards, or they're enabling people to launch a vertical bank for whatever kind of specific vertical that may be. I think that space is very interesting. I think there will be an infrastructure player or two that actually ends up providing a lot of the picks and shovels to brands. It could be an Etsy, it could be Lyft, which launched a debit card. Businesses that have customers and enable them to become financial services players. And I think it's kind of an extension of that. We are very excited about companies that start out as software companies that then have the ability to offer financial products. So we received investors in a company called Scale Factor. They are an automated accounting platform for SMEs here in the US. Raised about $100 million over the last year. Started out as a software business providing accounting software, but then they recently launched a corporate card for small businesses. And I think you're going to see a lot more both in the US and outside of the US. Companies that start out as software companies and become software as a blank, whether it's software as a lender, software as an investment, enabling kind of companies to become financial services companies over time, but starting out kind of providing a software solution that's sticky and recurring.
I think we spent the first 6 years investing in fintech, unbundling the bank, right? And at the end of the day, looked at it and said, boy, we've got all these little features of what should be a digital retail bank. Who's putting this all back together? And this was also as technology, what we carry in our pockets matured, you could start to put it together. So we went looking for someone who was putting it together, and actually turned out the UK was the most progressive market on this, in building that full service bank that was entirely digital, mobile first. We've since done that in probably 10 markets across the globe. To actually think about a holistic set of products and services that you get fully digitally as an individual or as a household. Because it is, you could argue that it's really hard to keep 10 different apps that take a little sliver of your financial life and fix it, right? Could you put it all together? So that's a theme we really like. Don't know if we'll touch on this later in the conversation, but there's a lot happening in the insurance space. And I think that could be very, very interesting. The early forays into, the insurance set of startups have been, how do we digitize acquisition and things like that. But now we're starting to get into two different real meaty subjects. How do we use data to change the way we understand risk? And also how do we use data and channels to change the types of products that are more relevant to people and risks that are more relevant to people. And we're seeing that here and across the globe.
And I don't want to take your role, Mark, because you're exceptional at it, but one question I would have actually for the panel is, we're going to talk about FinTech. And I would say, what percentage do you guys see that there's actual tech in it? Because I see a lot of things that are financial service or financial arbitrage. There's debit card interchange, there's a lot of stuff I can play with, and that's just a financial play. I can have some enabling technologies, but it's really more about the arbitrage. I see a lot of plays that are really the marketing side of the fence for consumers, where people are super, super good at SEO and figuring stuff out and how to acquire customers really, really, really cheaply and sort of provisioning them in a simple way. And I see a lot of stuff that, a little bit to the point that we were making earlier, is around process optimization, operations, where I just facilitate the process, make it more seamless to the end consumer. But actually, like deep tech or proper tech, I don't see a huge amount. So question to you guys, what sort of percentage do you see that's just FinTech or just thin something else, in what you look at?
Where's the tech in FinTech is kind of the question here. So who wants to take?
Sure, I'll take that in two ways. So I think it's a really good question. I think we think of some of the FinTech investing we do as technology for finance. So I think areas like cybersecurity are interesting from the perspective that they may have a real technology solution. We have a company called BioCatch that's fraud prevention detection business for banks. That's truly technology that's being provided to financial services. It doesn't have to be for just financial services, it could be for other industries. I think companies that are focused on spaces like that have the potential to be kind of technology for finance, could be for other industries as well. I think you also raised another really interesting point, which kind of in the world we live in right now is like the WeWorks of the world, and a lot of real estate plays, which I think are kind of intersecting with FinTech. You kind of have to ask yourself, like, how much of an asset-heavy model do you want to get involved with? I think in Latin America, we're seeing a lot of real estate plays, whether it's like an Open Door or a Z-Room, which is kind of like improve a, it's a company in Asia that basically improves kind of rents, like they'll improve an apartment unit, make kind of 2 bedrooms into 3, and then sell it at a higher markup effectively, or rent it out at a higher markup. And I think when you think about that, particularly in the real estate space, you look and say, okay, how much is there really tech involved? It's more tech enabled, but they're asset heavy businesses. And I think when we think about what spaces within FinTech to kind of look at, you kind of have to say, okay, what's the true value of these businesses? And I think that's the danger as FinTech investors will make it into, is whether it's a lending business, you may get lending multiples instead of tech multiples. And that's why I think you're seeing a lot of lending businesses try to transform themselves into some SMB digital banks for good reason, as they should. And I think there's a service or need to be provided there. But I think those are some of the interesting questions to think about. I think you bring up a great point.
I might start at the other end, which is, let's think about the customer. The customer, we know, except for the top 5-10% of the population, has extremely complex financial lives, anywhere in the world, right? And we've done a lot of deep research. There's this methodology called a financial diary. You essentially track every dollar in and out of a household account for a year. The average household in the US has something like 13 financial products. Not all of them are formal. And you go to a bank and you have a checking account or a savings account. A family that's comfortably middle class still probably has 5 different pockets of savings, 5 very specific needs they have in their lives. and you go to them and say, the bank's open from 9 to 5 or 9 to 4 and put it all in the savings account. It doesn't fit their mental model, right? And to get a big bank to say, create an account that has 5 different buckets, people can fluidly move money from one bucket to the other bucket, and it fits their mental model, is very hard to do. But the fintech is actually trying to do that because they're building the stack from the ground up. They understand customer experience and they're putting the time in to understand the user needs. So is that's tech-enabled, user-driven financial services that's more responsive to actually solving the problem, rather than starting with any fancy tech that falls flat when you actually go and test it with users.
Michael.
Yeah, I think that's a great point. And, I think these startups are able to start from scratch and really meet the deep needs and holes in the market for consumers, right? And you could call that a startup. A lot of them are saying they're a startup, and there's not much tech there, right? And so I think a question we ask ourselves a lot, because we do a lot of investing in prop tech, which is a subsector of fintech, real estate technology, and we have to ask, is this a venture-worthy investment, right? Is it asset-heavy? Is there any tech-enabling factor whatsoever here? And a lot of times, maybe it's just a better consumer experience. You could argue either way, right? And I think we have to know our place in the financing ecosystem and where our capital adds value and what type of investments we can really materially impact the outcome on. But it's something we talk about all the time, right? As we look at new companies. Real estate, I think, is probably the worst example of tech light, right? I mean, it's literally, I've backed probably 10 companies in the space, and that's always the first point of feedback we get from other investors is, where is the tech? And most of the times it's customer experience and it's data, right? They're using data in a new way to either acquire customers or better underwrite the customers. And you can kind of, call that fintech in some ways, but it's a challenge we all need to be aware of.
Well, so Matt, you raised an interesting question about, is this a venture worth investment? And as a journalist, I'd be remiss if I didn't ask the topic of the month, which is Libra. We've seen some major players pull out in the last few days. It's gotten a lot of interest, a lot of press, and it kind of is dominating at least the fintech discussion right now, rightly or wrongly. So my question to you as knowledgeable people in this field is, what's your take on Libra? Is it a good investment? Is it folly on Facebook's part? What's your thought on that?
I'll start with another thing that might have been missed in the news, because everyone talks about Libra as Facebook, and Libra was proposed as an alliance. It was proposed as a bunch of companies coming together, and that's why it's in the news now, because some very well-known alliance members left. And I think the complexity of Libra, before going into actually the value of having this currency, etc., is really around how do we make an alliance like this work. I personally was involved in the creation of the GSM Association, or its renewal around 2003 to 2006. It's really complex to bring players that are in principle aligned, even in the same industry, together and make them work. Governance is super complex. And all of the noise that's happening around, obviously, the initial proponent of it, which is Facebook, I think make lives a lot more complicated. I think what we're seeing right now might be because of a lot of things that are happening in the market and the pressure that is being exerted about Facebook. But I think one thing that has not been discussed, certainly by the press, is the fact is they're now creating an actual alliance. The rubber is meeting the road, so they're now having discussions around processes and governance and how things are done, et cetera, et cetera. And that might be part of the problem as well. Some of the players that are there are like, you know what, this doesn't quite work for us, and there will be unintended consequences, or there will be a bunch of issues around it. So the only thing I would sort of call people's attention on is this is at the end an alliance, and to make it work, it's actually incredibly complex. It's really more art than science at the end of the day. There's a lot of attrition. So I wouldn't basically say they're done and dusted. I don't think so. I think there are significant players still at the table. Facebook is a strong player, and there's still things that can emerge out of it. But they're sort of probably dealing with the pains of creating an alliance, and maybe that's something that they have had complexities dealing with even in the past, if you look at some of the internet.org dynamics, etc. So maybe there's some lessons learned for there on the alliance building side, rather than just the Libra concept by itself being an issue.
I'm not an investor in Libra, but I think as a general point around consortium transactions. For context, I worked at Goldman Sachs on the strategic investments team where we did a lot of consortium-driven transactions, exchanges, clearinghouses, things of that nature. They're great for the participants, but they're not necessarily great investments as financial investments. So that's what I would say on that. Not to say that Libra may not be. It may end up being great for Facebook, which I think has potential to be one of the biggest financial services companies in the world if they ever choose to go that route. They have the network, they have the people, and if they can kind of enable a way to facilitate the movement of money, then maybe that's good for them. But I think generally speaking, consortium-driven transactions tend not to be the greatest financial investments.
But I think the intent, which potentially is a frictionless, low to zero cost way to move money across borders instantaneously, is a fabulous sort of goal for all of us to think about what the systems that we need to build out to get there, whether it's Libra or not.
Yeah, I mean, I really hope it works because it'll bring the ecosystem to where it needs to be. And I'm glad Facebook took that first step, but alliances are incredibly challenging, right? Majority of them have not worked whatsoever. So they have a big road ahead of them. But I actually thought you were going to bring up WeWork because that is the other big piece of news.
Well, we can talk about WeWork. You got to take on that. You want to say other than being the most massively real estate leveraged pseudo tech firm in history, what else do you want to add about WeWork?
A lot of our investors are real estate investors, so our LPs in the fund, and a lot of them actually rent out office space to WeWork. And they joke and said it was probably the easiest negotiation they've ever done, right? Usually they come back to the table with 30 points that they have to change, and they're assuming they're going to get 3. With WeWork, they got 29. Right? So it's like, oh, this was an easy deal. I have more properties. Do you want them? But I think WeWork is fundamental to the startup ecosystem, right? They completely transformed what an office lease was and how quickly you can get set up with a company and actually have space for your team and grow with your team. So if WeWork does falter, I think it's going to have a massive, massive impact. It feels like and sounds like SoftBank's going to save them, but we'll see. But I think that there's another moral to the story, right? Is, growth at all costs is not necessarily the right model, right, for everyone. Getting to profitability as a startup is actually something that should be celebrated and something that should happen, right, sooner than later. As long as you touch profitability once, it could even be for a minute in your business, you know what it looks like. Then you go back to grow, but at least know what it looks like, and we'll give you more money to spend.
I won't talk about WeWork specifically. I think a lot of it's been written by people that are far more eloquent than I am and more analytical around their situation. That said, I think there's an interesting lesson learned around WeWork, Uber, and a bunch of other IPOs that were successful and IPOs that actually didn't happen, which is, number one, if we go back to the heyday of 99, 2000, and like the late 90s into 2000, the big issue was public markets. The big issue is that the end of the game was public markets, and public markets were fascinated by the new economy, and there was no profits, and magically everyone was worth a bunch. And Mark, I'm sure you have a lot of stories from those days.
Oh, yeah.
And I think the good news this time around is actually public markets are being the relatively rational ones. So the endemic notion that we will propagate this thing and it will end up in retail and consumers actually getting slapped at some point with a huge bubble that will burst, I think is really not there, and that's good news. I think the second thing is this will have a really good positive effect on valuations. It will start obviously with mid to late stage, and it will propagate as we've seen in the past. 2014, more or less, was probably one of the last readjustments. It will propagate back to early stage, so people coming to us with, I have nothing, 20 million cap on my notes, it's like, thank you so much, but no. I always use this indicator, which is, I call it the Y Combinator demo day price cap. And it's actually a really powerful indicator for the Bay Area, which is how does it float? And I remember, one of the first I went to was 8 million. It was 5, then it was 8, then it went like 12, then it went down to 8, and now I think the last one was around 15. Yeah. And it's like, it's going to come down, right? So I think this is great because we will have readjustments of valuations. Great news that public markets are not as nutty as private markets have been. And I think as an investor, I really look forward to the next year or a year and a half, because I do think we'll have significant readjustments in the market.
So what I admire is what WeWork has done in terms of creating a paradigm for how this space gets created. Michael and I spend a lot of time in places like Mexico City and Sao Paulo together. And there are now a whole bunch of co-working spaces that are even sector specific. There's a local Brazilian company that's created a co-working space for fintech, for health tech, and it's sprinkled all around it. It's made starting a company and thinking about real estate payments, right? So it's a real paradigm shift in how a startup gets to think about space and services and all of that. It's taken all of that off your plate as a founder. So without commenting on WeWork, what WeWork has done for the broader ecosystem is really to be, something to be.
The flexibility that
Flexibility,
startups.
yeah,
I mean,
sure.
if you have companies that are growing very fast, I mean, maybe they outgrow their office space, but they don't have time to get into a new office space, so they rent out WeWork. It's kind of for their dev team or their sales team, and it has definitely helped startup creation. I think the only other thing I'd add to the WeWork discussion is that I think it's certainly made a lot of investors and their companies really think through burn rates, how they should think about their capital raising strategy. If a winter is coming, then how should they prepare for that? So I think it's definitely made people think twice about things and made everybody go back to the drawing board. So I think from that perspective, it's probably not a bad thing because things have seemingly started to get a little bit out of hand, which, in a world where capital is plentiful, and I think is still plentiful because a lot of funds have raised and there's a lot of dry powder. So I don't know if there is a downturn. I think the venture ecosystem may be a little bit of a lagging indicator just because you have plenty of funds that have raised $1, $2, $3 billion plus funds. But it's definitely made people think about things a little more in terms of how they want to spend their money, what their growth plans are, which is probably not a bad thing.
Yeah, no, good points. Arjuna brought up a couple of things that I wanted to get into from a global standpoint because the fintech, just looking at some of the headlines in advance of the panel tonight, there was recently a Swiss-based group that invested $250 million in Indian fintech firms. Another set invested in companies in Mexico. So I'm curious to get your sense on what does the global picture for fintech investment look like? Are there certain areas of the world that you see right now as stronger or perhaps weaker than others? What does that picture look like for you?
You do a lot of emerging markets fintech.
You want to do the one door? Sure. Why don't you start with LATAM? And then
Sure.
I'll do-
Okay. We can start going a little bit south. So for context, we invest in LATAM in addition to the U.S. About close to a third of our portfolio is in LATAM, Mexico and Brazil mainly. I think they're quite intriguing markets for a number of reasons. So from a fintech perspective, you have a massive unbanked population. I think it's about 400 million unbanked people in Latin America. You look at cities like Mexico City, 25 or so million people. Sao Paulo, around 25 million people or so, maybe 22. Those cities in and of themselves, you could start companies and the TAM in those cities themselves be big enough to kind of build a decent sized company. So I think when you think about some of the dynamics of the region, and then you look at kind of provision of financial services, banks generally in places like Mexico and Brazil only bank the top end of the market. So you look at countries like Mexico, there's 50% cash economy, there's 15% credit card penetration, but yet 70, 80% mobile phone penetration. So you think about there's a number of digital banks that are kind of launching in Mexico. Nubank, which is a Brazilian company valued at $10 billion recently after a TCV investment. They have 15 million customers in just Brazil alone. They're moving into Mexico. So I think there's just massive opportunities on both the consumer and the business side. Just because banks are really not going down market just because they don't need to. Mexico has some of the most profitable banks in the world. On the small business side, the credit penetration is about 36%. So I think we get very excited about places like Mexico, Brazil, just because there's massive opportunities to do a lot of the things that you've seen happen here in the US, but just kind of blocking and tackling type fintech businesses, lending businesses. We have a small business lender that raised $42 million Series B, led by Point72 and Goldman Sachs, a big participant. That's called Credit Justo. They were profitable at Series A. So that's the other piece is you have very low burn rates, just because the cost to employ people is cheaper. So there's a lot of really interesting dynamics. And I think the other piece that's really interesting about LATAM fintech, at least from our perspective, is that you have all these unbanked people or businesses that are not banked. I think a large portion of the biggest fintech companies in LATAM will actually be companies that don't start out as fintech companies. So you look at companies like Rappi, which is a delivery business. They have a Rappi Pay business. high frequency usage models. We're investors in one of the leading micromobility businesses, scooters and bikes, that they have a payments product as well. So they're going to touch consumers very often, and these people are people who don't have banking relationships. So I think there's a huge opportunity to bank the unbanked through non-fintech companies that engage with the consumer a lot. So I think LATAM's really exciting to us. You also have SoftBank coming in. So I think that there's large amounts of capital, and I think that question's been answered. Is there follow-on capital? So I think it's become a very interesting region. Valuations may be a little bit expensive. You probably have a view on that, but it's still quite intriguing, and in some ways I think actually more interesting than the US right now.
So in this decade alone, we've probably brought 1 billion people into the formal financial services sector, which is an amazing strides. There's still 1.7 billion people who don't have any access to formal financial services. And that number is a very binary number, right? If you have some sort of digital wallet, you're counted. But if you look at people who actually have a proper suite of services, that's a much bigger number. And these numbers are all in the billions, but there are 1.5 billion people who have a cell phone who don't have a bank account, right? So there's so much potential for fintech to have an impact. If Michael sort of covered LATAM, I'll do very quickly to some of the other emerging markets. The massive impact in sub-Saharan Africa has been done by the mobile phone companies, who created probably 500 million mobile wallets that are now de facto payment systems and savings accounts for people. Right? India was very top-down. The government built this quite impressive technology stack, starting with biometric identification for 1.2 billion people, connecting into a payment network that they built in a switch that allows you to open an account and move money at zero cost. Right? So India brought hundreds of millions of people on, but with this top-down system. China's yet a different model, right? Ant Financial and Tencent brought 700 people into the formal financial services system on the back of commerce and chat. Right? So they tapped into that. Michael was saying they tapped into user behavior and brought financial services onto it. And Southeast Asia is taking a very different turn where in 5 years I could see 2 ride-sharing platforms being the largest retail financial services companies in the region. And it's come up very organically, right? They basically made each driver a cash-in, cash-out human ATM on the move. And the wallet had an immediate use case, which is pay for that ride. That same driver became your food delivery person and your e-commerce logistics person. So the wallet suddenly became this thing that got integrated into your lifestyle. And now they've got 25 other features. So you don't think about money. Money's become seamless. The way, for me, the part of the brilliance of Uber is that I never use my cash or my credit card, right? And I travel all over the world, and I just press that button and I get out of the car and leave. So how do you make payments and money just part of people's lifestyles? It's evolving very differently in the emerging markets compared to what's evolving here. And I live close to Apple and Google and in this area. Every time I go to Whole Foods, my teenage son doesn't understand why the way he starts the computer with his finger and logs into Amazon and just watches a movie, why I go to Whole Foods, which is owned by Amazon, yet I pull out a Chase credit card and then I log on to Citibank and pay my Chase credit card bill to pay Amazon. It's bewildering to him, right?
A credit card with a mag stripes.
Yes, exactly.
Yeah.
And as a fintech geek, I ask every checkout counter person, so how many people tap and how many people use Apple Pay? Half of them don't even know what I'm talking about. NFC. So we've got lots of behavior that we are fighting against in a mature system that people are leapfrogging in the rest of the world.
I wanted to emphasize precisely that point. I think I lived in China for 6 years, what they now call golden years, so 2006 to early 2012. And it's fascinating to me what happened, because this is not like they've been working at this for the last 15 years, right? Since I left in 2012, it happened. It just did, right? And I think the writing was on the wall that people were really leapfrogging. I think the big leapfrog effect was exactly what I think Michael was talking about earlier, which was mobile. Mobile just changed the rules of the game, right? And out of that, right, which the super apps that you talked about, obviously WeChat, being a very important proponent of everything that happened around the Alibaba ecosystem, e-commerce as well. It's just incredible. You have 70-something-year-old people who do not carry cash anymore. This was a cash-based society. They have a phone, and they go and they pay with their phone. And that's it. 70-something-year-old people. In some ways, we in Silicon Valley like looking at innovation here. And for many years, we talked about copycatting in China and copycatting in Southeast Asia. Grab, one of the co-founders of Grab, Wu-Ling, was my business analyst at McKinsey. Her first project at McKinsey was my first project at McKinsey. And I'm very proud of what she achieved. It used to be called My Taxi. I remember her pitching it to me, 2011 actually, over lunch. And I was like, are you really sure? Because obviously the Malaysian taxi cabs are pretty poor, but are you sure you want to do this? And now it's Grab, right? And I think the fascinating thing for us as venture capitalists and investors is where's the innovation now coming from? And I look, for example, around retail, I look at Alibaba, what they're doing with Renren in China is incredible, right? And they're years ahead of anything that Amazon's doing here. Years ahead. And so I think right now we're going to start seeing a lot more, not just like operational scaling innovation and process innovation and business model innovation in China. We're just going to literally see product innovation. I mean, going totally off piece here on the topic of fintech, TikTok, right? I mean, and that's going to be a geopolitical issue. It's already starting, right? So it's like, this is real. And we as investors need to start looking there. I think India, there's a lot of interesting things. Southeast Asia, there's a lot of interesting things going on. And we need to learn from those guys because we're going to start getting reverse copycatting. People here are going to start copycatting guys in China and Southeast Asia and India. And it's going to be fascinating to me to watch.
Matt, you want to add?
Yeah, I mean, we're early in kind of moving international. We just made our first investment in Brazil out of 50 that we've made between our two funds, but we're enamored with the opportunity. I spent a good 6 years in China as well, and just, I wasn't in the golden years. I was post 2012 to 2018. But it's amazing at how fast that market moves. And I truly believe that, India and Brazil and China and Singapore and South Korea and all these other areas are going to change the game, right? Like the game we're playing right now is going to get completely morphed and it's different. And unless we innovate faster, we're going to be left behind or we're going to be copying them, which may not be a bad thing, right? But they have all the right factors in place for massive innovation. Plus, they have a rising middle class that has more income and more cash to spend, likes affordable luxury, needs banking products, is investing in beauty, specifically in Colorado right now. And so these markets they're not necessarily comparable to what we're seeing here. They're actually one step or two steps ahead of us.
And on the FinTech panel, I'm surprised we haven't gotten to this earlier, but the role of regulation plays a huge in this, right? So in these markets where financial exclusion is such a problem, the regulator's more willing to allow for experimentation of non-bank, ride-sharing companies bringing retail financial services to the mass market. So we could have this conversation for hours.
Well, let's briefly touch on regulation, then I want to open it up. But that is this obvious stumbling block. What are you seeing out there? Same, better, worse? What's the climate like?
On the point of regulation, I think from Mexico, for example, the government I think has done some very kind of friendly things for fintech companies. Maybe not so friendly in other ways. So they actually created a payments product or a QR code that they want everybody to have in the entire country, rich or poor. That I think may end up actually hurting some of the kind of the Square for Mexico's, like Clip, which is Square for Mexico, General Atlantic, and SoftBank actually backed this company. But I think like that's great for the country, right, and great for all these people who have mobile phones and want to be able to pay for things digitally. May not be the greatest thing for a hardware point of sale terminal, but probably on a whole a good thing. But then on the flip side, in Mexico, for example. One of the unique features about Credit Justo or SMB lender is they can get tax invoice data on all the small businesses. So if you're a formal small business, and there are a lot of informal small businesses who don't want to report their taxes to the Mexican version of the IRS. But if you're a formal small business, you actually have to send every invoice to the IRS, and it's in a database, and you can actually get that data. So Credit Justo has, probably 25% plus of all tax invoice data on small businesses. So I think that type of thing can be very valuable when you think about underwriting a small business customer. And they're able to do that because banks aren't focused on kind of building a technology tool to plug into the APIs. So I think things like that actually make for pretty favorable and differentiated regulatory environments when thinking about fintech companies.
I think one of the things that's been the most fascinating to me, and just I think the example of blockchain has been incredibly illustrative on it, is regulation is effectively served as a way to disperse innovation dramatically, right? Because when we're talking about all these technologies, like clearly US and the Bay Area, clearly China, clearly a bunch of other stuff, and then we look at, for example, some of the stuff that's happened around blockchain, Switzerland, Singapore. So I think the dispersion of innovation, the dispersion of talent as a function of what happens around regulation, how open the markets are, is really interesting. And if you're thinking at a country level, you're like, okay, how do I create this? Singapore has always been very good at this, right? I mean, that's sort of the great secret of Singapore Inc. has been effectively that, right? The figuring out how do we become friendly to business, how do we figure out the right way to do it. But that playbook is really, really interesting to me. And, without going into a lot of details, as I said earlier, I think some of the stuff that we've seen from the SEC recently has been positive because it at least clears a lot of stuff up. But what we saw was proactive regulation in some markets that really facilitated this dispersion, which I think is very, very unique, right? Talk about competitive advantages of a country and a nation in attracting talent and companies to themselves.
All right, let me borrow the mic here. So we've got a few minutes left here. I just want to give the audience a chance to ask any questions that they have. This has been a great discussion. It's a great panel, but you probably have some of your own. So who would like to ask a question tonight? Or a great panel. I can't believe we've got, there we go, okay.
Have you guys seen a lot of stuff come out of Wall Street? Looking to, venture capital and figuring out like the Silicon Valley way to do whatever it is we do, Have you seen people there because they understand the regulatory stack? And it's astonishing that there isn't more of that.
I will talk about the examples I know. I'm not sure they're fully exhaustive, so I'm not sure I'm an expert in Wall Street, but I'd say two things. Well, Wall Street, and I would say Connecticut as well. So two things that I think are happening. On the Wall Street side, I think we see some of the players really being a little bit more thoughtful about the integration of innovation. Some of these players are doing pretty well. I think JP Morgan has been very aggressive as a corporation to try and attract talent, to try and attract companies, and to try and do things around it. You look at Goldman Sachs with Marcus's and a couple of other plays that they've done. That might actually be their play, which is how do we transform ourselves from being an investment bank into something that's probably more full service provider. So I do think there are some very aggressive bets by those guys. Some others are probably a little bit lagging behind. The Connecticut angle of hedge funds, I think, is very obvious. They are very strong participants in the market right now. We start seeing some of these players like Coatue, Point72, and a few others, coming mid-stage in growth and then doing early-stage investments, and I think that's unavoidable. These guys have a lot of capital under management, and if they find the right, what I'd call the right portfolio manager construct for it, which they've done on the hedge fund side, they can be actually pretty significant players. And think about it, they have actually a lot of data. They buy a lot of data. They process a lot of data, right? Now, I'm not saying there will be the best guys in early stage, because early stage, there's a lot of other dynamics to it. But I'm a quant guy, analytically driven. That's how Strive Capital was created. It was about being different and focusing really on how you become better at picking. And my thought was analytically driven is the only way you become much better at picking. These guys have a huge unfair advantage, right? Not just capital under management, also their tech stack. So I think it's interesting what's happening, and I don't think they're all sleeping. They're maybe a little bit stealth sometimes, but they're not sleeping for sure.
I mean, we're actually seeing them come into venture rounds with sizable checks, right? They're not leading the rounds necessarily, but they're dropping $50 to $100 million into these startups. And they're also very open to do partnerships and open up their customer base, open up their development resources, open up their data. We've seen it with a few of our portfolio companies, and it's exciting, right? Because for a period of time, it was, we're going to crush the startups. Now they realize, okay, they can actually make us better. We can learn from them, and we can actually help together.
I think I agree with all of that. I think banks may be slow in some cases, but they're certainly not dumb. I think the one thing I would add to the discussion is while we have seen a lot of partnerships, we've seen a lot of investments, what we have not seen as much of is acquisitions. I think probably a few years ago, a lot of fintech investors would have said, there's going to be a lot of banks acquiring fintechs. I think you haven't seen that happen for a number of reasons. Either Goldman in Marcus's case created one. Now they did acquire Clarity Money for $100-some million, 120 I think, and that's kind of helped them build their business. But for the most part, you haven't seen banks actually acquire fintech companies. That probably would have been one of the bigger. A few years ago, I would have said that would have happened more often. I think what that also means is that as FinTech investors, I think I won't speak for you guys, but I've probably seen similar things, is that you want to build great standalone businesses. Maybe they end up partnering with fintechs or start with incumbents, but for the most part, I think as a venture investor, where is the value? It's in creating large standalone business that generally end up actually competing against banks or building or serving a new customer cohort. SoFi, we're both investors in Moneyline. That's another example of serving kind of the subprime consumer, which a lot of banks, maybe say for like a Capital One, wouldn't go after. So I think that's kind of been, I think, probably one of the more interesting points over the past few years when it comes to kind of fintechs and incumbent collaboration.
Other questions? I think I might ask a slightly provocative question. So, would you agree that there really hasn't been a fintech yet that has actually competing effectively with an incumbent that isn't, and if so, why? And what I mean by competing is not taking a niche, not maybe taking an underserved market, but actually reaching a level of scale where they can compete with an incumbent. And if not, why? Is it regulation? Is it incumbent status? Why?
Who wants to take that one first?
So I think one example of a space company where there has been kind of a fintech actually beating incumbent, because I think there's a lot of cases where they may seem like they do at first, like Lending Club seemed very innovative at the time, but then ultimately they had to kind of go the arc of pure peer-to-peer retail and then the arc of institutionalizing. And I think that's actually an arc that many fintechs follow, just because institutionalization of your platform is where you get volume and scale. So I think a lot probably haven't actually innovated as much as we thought they would. But one area I think where there is a lot of innovation is kind of the area that Carta plays in. So kind of, cap table management, 409A valuations now. Solium Capital, which got acquired by Morgan Stanley for kind of just under $1 billion. They focus more on kind of top end of the market companies and public companies. Carta focuses more on early stage companies. But I think that's a business, if that works, and they're able to create a private market stock exchange. There are other companies out there. Forge is doing that as well. They've kind of started at the other end of the market. But if Carta is able to do something like that, I think it could be a vastly larger business than Solium. If it works. Now, that's the question is, can they make a jump from being a cap table management platform and kind of 409A valuation platform to being a private company stock exchange, and or taking companies public themselves, maybe doing direct listings, things of that nature. But they have all the ingredients to do it. They have the network effects, they have all the investors, and they have the mapping of every single asset, at least as many as they're going to get, which kind of give them the ingredients to do that. So that's a space where I think actually the startup provides a decidedly better experience than the traditional incumbent, and B, if they're able to do it, probably is a much bigger business if it works.
So, given the nature of our fund, right, we have a sole LP in the Omidyar family, and they have a very different objective for us, and how do we actually change the way the system operates? I'd say what this fintech system has done is provoke a competitive response from the banks. If you look at the UK, there was an oligopoly of 4 ossified banks that hadn't changed for 150 years. Now, each of them have launched a digital subsidiary that's completely branded differently in response to the fintechs. Same thing in Brazil. You start to see it in Southeast Asia. So there's this competitive response from the banks, whereas the scale might not yet be there, the system is changing. And I think that's from our perspective, one of the brilliant things about fintech. And this is an old story. You said you worked at E-Trade, right? If you look at E-Trade and Schwab, I don't know the statistics, but they don't have a huge fraction of the AUM, still in the traditional players. But 20 years ago, it was $99.99 to make a trade. It's now virtually free. because the competition drove everybody to drop their prices. So if you think about the systemic impact of what we're seeing today with the fintechs, it's much deeper than just saying, okay, great, so you've got 2 million customers compared to the 20 million that the big bank has.
Any other questions? Real quick here.
Thank you, the panel, for sharing your experience and insights. I learned a lot. I have a question on China. From a U.S. investor's perspective, which aspects of the Chinese fintech industry provide the most potential and most exciting opportunities to you guys? I'm asking because you mentioned that one area that may be interesting to you guys is that the existing business model or product in China that works really well. We can borrow that idea. One comment I have on that is, about this idea is that China is very different in many, many ways. One is that it has a huge population base. So an idea, even a niche idea, can survive. It arguably has the best ecosystem for fintech to grow in China. But what works in China, a niche market can survive because the population, like 1% of the population wants this product. That's a huge market. But that same niche idea may not work in the US because the population base isn't there. So I'm just curious on which aspects of the Chinese fintech industry are most.
So a couple of disclaimers. First, I don't invest a huge amount in China. Although probably one of the rock stars in my first fund was originally a Chinese company, Apani, which today is seen as a San Francisco company. But it was started by a foreign guy in Beijing, and still it's one of their largest offices, if not the largest, and their sole really big engineering office. So I'm very cautious now to invest in China. I need to know who my partners are, who the other investors are. There's a few incredibly good funds in China, like IDG Capital, GSR, GGV. There's a bunch of funds in China that are awesome. So just put a disclaimer out there. So it's a little bit more about the copycatting idea, and I'm sort of, going back to your original question, which is, does it scale in the US? The US is not really that small, right? I mean, 300-something million people is a fraction of China, but it's not a smallish fraction of China. And the other thing that we need to take into account is GDP per person, et cetera, is very different from China still. So there are niches in the US that can emerge and become significant even in the fintech space. And I think we'll start seeing it. I think there was an initial point, maybe Michael, you made it, which was there's verticalization of solutions and services to specific markets. Like, if you're a student coming out and you have student debt, there should be better propositions for you in terms of banking, better propositions for you in terms of savings and investments than you currently have from the big bracket banks. For sure, there should be. And that niche by itself is very significant. Although this is not the population of China, it's very significant. So I would sort of push back a little bit on that. I think even niches in the US, that's how the US market was built, and that's how venture capitalists make all these big investments. Sometimes you don't need to go well beyond the US, right? You can be insular and you can make a lot of money here. Now, I think that's changing. And it's changing because in certain areas, the competition is actually becoming very international. Financial services, I think, is still actually one of those areas because of regulation, because of habits, etc. It's still very, very domestic. It's still very country by country. And it will be very difficult to, I think, pass that barrier unless, something dramatic happens in the world the next decade or so. So in my view, that will be the case. We'll continue having domestic plays, we'll have fintechs, we'll have a lot of copycatting going around back and forth, which is good because now we'll start copying from them and they'll start copying from us afterwards, et cetera, et cetera. So I'm very bullish on it. I think niches can be significant.
All right. Well, thank you very much. We've run out of time here, but please give our panel a warm round of applause.